All right, let's talk about something that sounds a bit dry. Accounting for investment property. But trust me, once you get into the rules, you uncover this really fascinating secret. And it's that a company's books can tell a very different story from what's actually happening in the real world. Let's dive in. So, this is the big question we're trying to answer today. You'd think that if a company owns a building, its value would be pretty straightforward. But the short answer is it totally depends. It depends on what the building's being used for, how the company got it, and which specific accounting rules come into play. Okay, first things first, let's get our key terms straight. An investment property is not the company's main factory or its own office headquarters. Nope. This is a property they hold specifically to make money from it, either by renting it out or just by waiting for its value to go up. Think of it less like a workspace and more like a financial asset that just happens to be made of bricks and mortar.
Now, for our first scenario, we're going to look at what happens when a property has, let's say, a career change, and you'll see why that exact moment is so important for the balance sheet. So, let's set the scene. Picture a company, and they own their own factory. In accounting speak, this is an owner-occupied property. It's part of their day-to-day business where they actually make their stuff.
Let's put a number on it. Let's say they bought this factory a few years ago for 10 million rupees. That's our starting point. But, as you know, buildings don't stay new forever, at least not on paper. Over 4 years, the company has recorded 4 million rupees in depreciation. That's just an accounting expense to show the wear and tear and reduce the factory's value on the books over time. So here's where we land. You take the original cost, 10 million, and you subtract that depreciation, 4 million. That gives us 6 million rupees. This is called the carrying amount. It's basically what the factory is officially worth according to the company's books right now. Okay, now here's where things get interesting. The company stops making things in the factory. They decide to rent the building out to another business instead. The second they do that, bam! The property's job description changes. It's no longer owner-occupied, it has officially become an investment property.
And this creates a real puzzle. Let's say the real estate market is hot, and an appraiser says the building is actually worth 8 million rupees today. So now we have a conflict. The books say 6 million, the real world says 8 million. So which number does the company get to use? You might think they jump at the chance to use the higher number, right? Well, the accounting rule here is surprisingly strict. The property gets moved over to the investment property category at its carrying amount. That's right, it stays on the books at 6 million rupees. And that extra 2 million rupee increase in real-world value? Poof, it just isn't recognized. The book value doesn't budge. Okay, so that was one scenario. But what if a company doesn't buy a property with cash? What happens when they trade for it instead? This is where the rules get even more interesting. So our company's got this warehouse they don't need anymore, and it has a fair market value of 5 lakh rupees. They find someone with a building they want, and they cut a deal. They'll trade their warehouse plus 2 lakh in cash for the new building. Now, the standard rule for a swap like this is pretty logical. You figure out the cost of the new thing by looking at what you gave up to get it. So that's the 5 lakh fair value of the warehouse plus the 2 lakh in cash. Simple enough, right? The new building gets recorded at a cost of 7 lakh rupees. But, and this is a really big but, there's an exception. What if there's just no question about the new building's value? Like, what if it's just been professionally appraised and there's clear, undeniable proof that its fair value is actually 8 lakh rupees? This is what the rules call more clearly evident value. And this is a total game changer. It's the complete opposite of what we saw with the factory. Because the new building's value is so clear and easy to prove, the company is allowed to record it at that higher 8 lakh figure.
And that 1 lakh difference between what they gave up and what they got, it flows straight to the profit and loss statement as an immediate gain. How about that?
Okay, so we've seen how book value can be stuck in one case and flexible in another. But the story doesn't end there. Because now we have to talk about the final, critical job for accountants, disclosure.
So this probably has you wondering, right? Let's go back to that factory. It's sitting on the books at $6 million, even though we know it's really worth $8 million. Does that higher, real-world value just disappear into thin air from the financial reports?
And the answer is a big, resounding no. The accounting standards basically say, not so fast. Even if a company sticks to the historical cost on its main balance sheet, it absolutely must tell investors what the fair market value is. This juicy detail goes in what's called the notes to the accounts. You know, the part that tells the whole story. And they don't just stop at fair value. Companies have to disclose a whole lot more. Things like how much rent they actually earned, what they spent on upkeep for properties that are rented, and for those that are sitting empty. And they have to give a detailed step-by-step breakdown of how the book value changed from the start of the year to the end. It's really all about transparency. So let's pull all these threads together. Why go through all this trouble with these complicated rules for transfers and swaps and disclosures? What is the big picture here?
Here's the one thing you absolutely have to walk away with. The value of a property on the balance sheet and its value out in the real world can be miles apart. The carrying amount is a story about history and accounting rules. The fair value is about what it could be sold for today. These rules are all about consistency, but they create a gap that any smart investor really needs to know about.
And that leaves us with one last, big question to think about. If the book value isn't always the market value, then what story are a company's financial statements really telling us? They're not just a price list. They are a record of history, of choices, and of rules. And understanding that difference, well, that's the key to truly understanding a business. Thanks for tuning in.